We're good.
Yeah, it doesn't theoretically recording.
Theoretically. All right. Thank you for joining, everyone. Today we're going to talk about personal finance. As everyone knows, we've been talking about this in the office a lot, and I've been jotting down ideas, and I started making a slide deck to give this presentation to everyone. And, you know, as shall come to no surprise to anybody, quickly after I started that process, I ended up with 100 slides. So now we're going to break this into 2 days. So today is part 1, tomorrow is part 2. Quick disclaimer, I am not a fiduciary financial advisor. This is free advice. Please do your own research. You can take the advice or leave it. A little bit about the advice that's in this presentation. It's all compiled from a number of excellent online sources and books. Some of this advice is my own personal advice, but the vast majority of it has been compiled from excellent financial advisors, and I'll give you a list of those books at the end. Where possible, I have included links to external references, so when I send out this PDF later, you can just click to get more information. A little bit about me. My name is Marcus Hodges. I have a bachelor's degree in mathematics from the University of Washington. During the day, I work here as the Director of Research at Security Innovation. I'm a bit of a finance nerd. I've been a finance nerd for a long time. I consider myself to be a reasonably experienced investor. I, for a while, experimented with day trading, with derivative markets and options trading. I have a fair amount of experience in real estate and rental properties and whatnot. But mostly it's just, as a finance nerd, I've read a lot of things and compiled that information to share with you. Why did I do that? Well, I wanted to improve awareness of some important topics. I wanted to tour a broad spectrum of finance topics, so you'll find that any particular slide in this presentation you could go into much more depth on, but I just want to make sure everybody's aware of the basics. You can drill deeper later once you know what questions to ask. I'm going to emphasize the things that matter most. All of the strategies I put in the slide deck are very simple, effective, and don't require a lot of time to implement. That's my emphasis. You can spend as much or as little time dealing with finance as you want. It can be an incredible time sink if you want it to be. At the end of the day, I just want to help you understand what questions you should be asking and think critically about your long-term finances. Okay, 2 parts. Today we're going to cover basically Economics 101 and retirement planning. I'm going to cover compound interest. I'm going to cover basic expenses, lifestyle, opportunity cost, pre versus post-tax income, marginal utility, budgeting, insurance, emergency funds, and retirement planning. Tomorrow I'm going to get into the minutia of the stock market, the difference between index funds and mutual funds, bonds versus bond funds, investment strategies, 401k, matching capital gains, taxes, all that. So it just gives you an idea of how this is broken down. So part 1, financial literacy. I've scattered in a lot of really great quotes and wisdom. This is a quote that was attributed to Albert Einstein. I don't think he actually said it, but it's a good quote nonetheless. Compound interest is the 8th wonder of the world. So let's talk about it. Your investments, when you take money and invest it, that compounds for you. Everybody knows that having money makes money. Equivalently, your debt compounds against you. So anytime you take out a loan and borrow money, they charge you interest. It has the same exact effect as the compounding of your investments, just in the opposite direction. The compounding effect is very powerful. And just for reference, everywhere I'm going to be referencing the historical stock market average most people consider to be 6 or 7% per year. That's an average over the last 100 years. A lot of people have studied this. I'm fairly conservative in my planning, so throughout this slide deck I'll be using 6% as a basic investment.
Is that before or after inflation?
We'll talk about inflation. Let's look at basic compound interest. If you took $10,000 and invested it in a vehicle, such as the stock market, that gets 6% per year growth, and this is a one-time investment, you put it in on day 0 and you let it grow, This is how much money you would have at the end of 30 years. $57,000. As compared to simple interest, which is a one-time increase in your principal, a $10,000 investment on simple interest over 30 years, you'd end up with $10,600. The compounding effect is powerful. We're going to come back to this over and over again. But just very basic economics 101, this is what that looks like. Now let's build on this. If you were, instead of to take $10,000 as a one-time investment, if you were to instead just save and invest $1,000 every year, just at the end of year one, you put in $1,000. At the end of year two, you put in 1,000 more, and you keep it. At 6% growth, at the end of 30 years, you'd have $83,000 plus $1,000. The amount of money you put into it over the 30 years at $1,000 a year is $30,000. Fairly basic, right? That's the investment. Now, there's a big difference here between if you choose to invest versus choosing not to invest. If you choose not to invest, you will end up with $30,000 in your savings account at the end of those 30 years. If you choose to invest, you'll end up with 83. Very simple choice, huge impact. There's another line on this graph that's interesting, and that is, let's suppose you do nothing for 10 years, and then you start putting in $1,000 a year. So you've only contributed $20,000 over a 20-year time frame with a kind of a delayed late start. You will still outperform just saving $1,000 a year and not investing. So this is kind of the basics of compound interest. It also presents something called opportunity cost. So in all three cases, you saved $1,000 a year. The opportunity cost of choosing not to invest was $53,000. Opportunity cost is a hugely important topic. I'm going to come back to it a lot. But let's just back up a little bit and think about that. So I'm saying the opportunity cost of non-investing was $53,000. That means you put in $30,000 in a savings account, you end up with $30,000. If you put it in investment, you end up with $83,000. The difference is $53,000. Some people, I have heard people say, oh yeah, but that's not real money. Like the $53,000 is opportunity cost, but it's theoretical. Anyone who made the choice to invest it, where that money ended up in their bank account at the end of 30 years, can tell you how very real that money is. And the people who chose not to invest it, that end up with $30,000, they're the group of people that will tell you this is theoretical. So I can assure you that $53,000 is very real. And then the opportunity cost of starting late is less, but it still outperforms saving, which is interesting. Okay, next Finance 101 topic, delayed gratification. So let's suppose for the past 5 years, you kind of built up and you saved $10,000. And you left that in the market and you let it grow at 6% for the first 5 years. And now it's today, and you want to buy a car. And the car costs $10,000. And you have the $10,000 cash, so you can just buy the car outright. What is the difference in opportunity cost of choosing to purchase that car today for cash, choosing to wait 5 more years, let the investment grow a little bit more, and then purchase the car for $10,000 cash, versus buying the car with a loan, even though you have $10,000 cash to buy it? Again, and everywhere in the slide deck, you'll notice I pretty much always assume a 30-year time frame and 6% compounding interest. This is what that looks like. So here you can see this is a 30-year scale. You can see for the first 5 years, everybody does the same thing, and everybody had their $10,000 and it grew a little bit. You ended up with like $13,000 or $14,000 at the end of year 5. And then one choice is to buy the car at the end of year 5 outright for cash. That's the green line. Or you can wait 5 more years, let your investment grow at 6% for 5 years, and at the end of year 10, pay $10,000 cash. and that's the blue line. And then the red line is what happens if you take out a loan to purchase the car. This is a 5-year loan with a 6% APR. I'll come back to APR and how loans and how amortizations work, but the point being you're slowly paying it down. You're paying off about a fifth of the car every year over a 5-year timeline. This is how that plays out over 30 years. As should come as no surprise, if you delay your choice to spend money and keep your savings in your bank account as long as possible, even though you're spending $10,000 in both situations, you will end up with more money at the end of 30 years. And the difference is considerable. In this case, you can see it's about a $10,000 difference, which is pretty impressive. It's a surprising result because in both cases, you spent the same amount of money on the same thing. It's just as when you chose to do it matters. So a little bit about loans. And this is as good a time as any to introduce that topic. So if you take out a 5-year loan for a car, amortized, your monthly payment is $193. Let's talk about amortization and what that means, just briefly. So the principal is $10,000, and you're going to pay 6% per year. That's what APR means, annual percent rate. So take the $10,000, 6% or $600 is what you're going to pay in interest to the bank for the privilege of giving you a loan, and that's per year. But if you can imagine, at the end of the first year, you will have paid down some of the principal. So when you calculate 6% for year 2, it's not $10,000, it's some number less than that. It's maybe 6% of $8,000, and 6% of $5,000, 6% of $4,000. So your payments are diminishing. Amortization is the process of doing all those calculations and then restacking everything so that your monthly payment is the same all 5 years. Otherwise, your monthly payments would be huge the first year, slightly smaller and kind of diminishing. But the consistency is nice. The side effect of amortization, and the beauty of it to the bank, is that you pay more interest the first year than you do the second year than the third year. So the amount of principal you're paying down is considerably less early in the loan's life cycle. And again, this is something you can learn more about by searching amortization. Okay, that's compound interest. That's the basics of how money grows, and some really simple choices on that. Let's talk about this fine burrito I have sitting in front of me, or what I like to call the curious case of the $100,000 burrito. But first, we'll start with a quote. Thanks to my friend Arvin for sharing this with me. From climbing, I understand the difference between essential and excess, and I have an abiding suspicion of luxury. Light is right, and the secret to wealth is living not within your means, but beneath them and liking it. Most of my essentials are luxuries in today's world, and they can't be found in a store. Quietness, cleanliness, open space, sunrises, sunsets, the time to watch them, and firewood. Okay, first let's define some terms. For types of expenses, there's kind of, at a gross level, you can choose whether or not an expense is essential or whether it's discretionary. Essential really means just that. You have to have food, and I mean the basic subsistence or you'll die. You need to have shelter over your head, you need to have clothes on your back, that's about it. Healthcare, those are your essential expenses. Discretionary things are things that make your life better, more comfortable, more enjoyable, but you won't actually die if you don't have them. So, your Spotify account, your Flickr account, your Netflix account, fancy food like El Gaucho steaks aren't, even though food is necessary, El Gaucho is not, but I love that restaurant. Really, really fast internet connections are not actually essential, believe it or not. And then, of course, you can also categorize your expenses as whether or not they are fixed, which is a monthly recurring predictable expense. It's basically the same every month, like your rent or your mortgage payment is a fixed expense. Your electric bill, your utilities, these things have some fluctuation, but they're more or less like you have to pay them every month. You can't not pay them. Yes.
Why wouldn't Netflix and Amazon Prime qualify for fixed?
Ah.
Besides Spotify.
Good question. They are fixed. So here you have, when you're categorizing something, you can label it. And you label it as essential or discretionary. And at the same time, you can also apply the labels fixed or variable, right? So you can have two labels. Good clarification, right? And anything is variable is just like something that doesn't have the same price every month. So Amazon Prime is a fixed expense, but it's also a discretionary expense. So now let's talk about lifestyle choices. Again, let's make some assumptions. Let's assume you make $100,000 a year. It's just a nice, easy, round number. If you make $100,000 a year, you pay $21,000 in taxes. I'm rounding off a little. That is not a discretionary expense. You have to pay your taxes. So you also have to pay your rent and your healthcare premiums and whatever. So those are your fixed essential expenses there on the left, about $36,000. This is just a rough guess is what a $100,000 income might look like. What's left over is about what did I put? $33,000 is the leftover amount. Was that?
43.
Oh, 43. Yeah, can't add. Awesome. So what you get to do here with your lifestyle choices is choose basically how much of it gets spent discretionary and how much of it gets saved. So if you cancel your Amazon Prime membership, that's your lever, you will be saving more and spending less. If you sign up for, some more discretionary expenses, then you save less. Like, you don't get to change your income. Your income is fixed, right? We'll talk about that a little bit more later. But on a day-to-day basis, your income is a fixed known quantity. So let's look at some examples of how these things play out and do some math. So I'm going to pick on Chipotle because they make delicious, delicious burritos. And let's consider the example that, because you have to eat lunch, right? So you can't skip lunch, you need to eat. So let's suppose in one scenario you pay $5 for a Trader Joe's lunch versus $10 for eating out lunch as a burrito, right? So the net saving here, the amount you can actually choose to save is $5. You can't choose to save the full $10 because you actually do have to eat. So $5 is the difference. And if you think about the number of work days in a year and you eat out every day, that's 260 times a year. Again, you'll notice these are abstractions. Like, everybody's life is very, very different, so I'm making huge generalities here. But that would add up to about $1,300 a year difference. That's, again, the difference, the $5 a day. Let's look at some other kind of discretionary expenses. Digital media. I have clumped together a group of them that add up to $456 a year. So that includes an $11 a month Amazon Prime internet, a Netflix subscription, and faster internet. And what I mean by that is probably you have to have an internet connection if you work in this industry, but you can choose to have the 25 megabit one versus paying extra for the 100 megabit one. So your net discretionary spending for the upgrade is $180 a year. And then restaurants. I'm assuming if you eat in a restaurant, it's going to cost you about $40, versus if you eat at home, it will cost you about $10. And let's say you eat out twice a week. So $30 is what can be saved or not saved on that difference. And at twice a week, that adds up to about $3,120 a year. Now let's look at how these numbers play out over a 30-year timeline. And let's assume you're also saving $500 a month in general. So any savings you make by changing your lifestyle are in addition to that that $500 a month or $6,000 a year. This is what happens. So if you do none of those things, if you don't have the burrito, you downgrade all your internet connections, you cancel Amazon Prime and Netflix, and you never eat out at restaurants for dinner, you will end up with $911,000, just shy of $1 million, when you save $500 a month. So if you pull that lever in that direction. If all you did was subscribe to the Amazon and the faster internet and what have you, the digital media, at the end of 30 years, you'll end up with $873,000. Similarly, if all you do is your only discretionary, like, pleasure perk is the Chipotle lunch, you'll end up with $800,000 at the end of 30 years. Restaurants, you'll end up with $650,000 at the end of the 30 years. And if you did everything, if you eat out twice a week, if you have all the Amazon and Prime accounts, and you eat lunch out every day at Chipotle, you'll end up with $500,000 at the end of 30 years. This is the opportunity cost of the different categories. The burrito lifestyle choice over 30 years at 6% interest actually costs you $108,000. Digital media, about $38,000. Dinner twice a week, $261,000. And if you do all of those things, the money you're missing out on at the end of 30 years is $408,000. Right about now, you should be thinking, those are bigger numbers than I thought. Wow. Because they are. The result is surprising. But when you actually do sit down and you actually calculate the money you miss out on, the opportunity cost, this is what it adds up to. A nice bit of wisdom from our friend Andrew Tobias, who wrote a great book, which I'll reference to later. Most of us feel like we couldn't get by on a penny less. But all a family struggling to get by on $190,000 a year need do is look down the street to see a family that somehow manages to get by on $165,000. They probably do their own pool maintenance. A family struggling on $24,000 a year need only look down the street to see one surviving, don't ask me how, on $18,500. The point is that you can save money if you're willing to make some sacrifices. And it's wise to do so. Because even forgetting retirement needs, rainy days, and all of that, if you can only arrange for things to come out a little ahead each year, instead of falling a little further behind, you'll quickly find your financial security, and not long afterwards, your standard of living improving. Money does make money. The rich do get richer. And they sleep better. Okay, next topic. Pre versus post-tax income. This is an important thing to take into consideration when you're making decisions about how you spend. Again, we'll stick with the really easy to calculate assumptions that you make $100,000 a year pre-tax. You have to pay income tax on that. You don't get to keep the entire $100,000. That means in your pocket you get to keep $78,000. That is your post-tax income. Okay, everybody's probably already familiar with that. So post-tax income is the money in your pocket. If you look at the math on this, depending on what tax level you're in and what have you, for every $10 you spend, you really have to earn 13. In other words, every dollar you spend, you needed to earn $1.27. But I'm not even accounting for sales tax at this point, because you don't actually get to spend $1 and get something that costs $1. You need to also spend the sales tax at 10% in this state. So the reality is, for every dollar you spend, you have to earn $1.37. So the money in your pocket, the money in your savings account, is really worth more than you probably realize it is. So the conclusion here from all of this is that reducing your spending is actually way more powerful than increasing your income. And in fact, again, the numbers vary by individual, but how much more powerful? About 37% more powerful. Okay, so if you want to actually earn $10,000 more, you can just save that $10,000. Or you can get a raise for $13,000 or $13,700, right? So you need a much, much bigger raise than you actually do if you're just saving pennies. That's why all the great financial wizards of the day will always tell you, save, 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 save. It's extremely important. Now that said, they're not mutually exclusive. So if you can increase your savings and also at the same time increase your earnings, then you're doing really great. So the advice is not don't increase how much you can earn. In fact, in the great book, The Richest Man in Babylon, that is the seventh secret to success, is increasing your ability to earn. So this is also something you should be doing. Advance your income potential. Perfect your professional skills. If you really want to earn more, you might need to change careers. Like if you're a bartender, go back to school, become a computer scientist. That's a choice that will really pay off over time. You can continue your education. This is basically a form of investing in yourself. It's an excellent use of time and money. Pick up a new skill, freelance or moonlight. You know, you can drive for Lyft in the evenings to make extra money on the side. You really can increase your earning ability if you think about it. There's always a way. George Clason says, thus the seventh and last remedy for a lean purse is to cultivate thy own powers, to study and become wiser, to become more skillful, and to so act as to respect thyself. Okay, what's the point? What are we talking about? Why do we even care about money? I'm spending all this emphasis on earning and how much you need to earn and how you should be saving your money, but why? Why? What's the point? Why should you even care about money? Well, it turns out money has a certain amount of utility. Utility is a term in economics that basically means benefit. This is different for everybody. The benefit of having money to me is much different than the benefit of someone else having money. You get to make choices about what makes you happy. So this is a little bit about know thyself. But in economics terms, utility is the measure of benefit or satisfaction gained from not the saving of money, but from actual spending of money. So the money itself doesn't have benefit, but purchasing a new car maybe has benefit. The new car gives you benefit, and you exchange the money for that thing. So from consuming goods and services. How will having more money benefit you personally? This is a question you should ask yourself. What are your long-term life goals? I myself find that one of the most important things to me personally is freedom. As I have money that's generating money, I am less dependent on my day job, and I can work less and play more. I like to have, you could, to some extent, money and time, you can trade those off for each other. Some people really just want to retire early or retire at all. It's getting harder and harder. Some people love to travel. Some people want to spend time with their families or buy a sailboat. What is the utility of money to you personally? Something you should think about. Something else you should think about is the marginal utility of money. Marginal utility, in economics term, is the increase or satisfaction from each additional unit consumed. A really good example of marginal utility is pancakes. I love pancakes, and if I'm really, really hungry, purchasing a pancake will make me satisfied. All right? That first pancake really does it for me. It cuts the hunger, I feel better, and I really enjoy pancakes, especially with grade B maple syrup from a farmer's market. There's no beating that. But that's the first pancake. So what about the second pancake? If one is good, two is twice as good, I'll buy two pancakes, okay? But by the time I eat the second pancake, I'm like, all right, I'm I was already a little full. The first one cut the hunger a little bit. So the second pancake has slightly less utility, slightly less benefit than the first pancake had. Similarly, the third pancake has slightly less utility than the fourth pancake. And if you continue this, utility can actually be negative. If you consume too much of any one thing, you can overconsume, you can actually end up with negative utility. It's actually detrimental to you. But the thing about pancakes is each one costs the exact same amount, even though the utility diminishes. So that's what they mean by utility is marginal. The utility of something is not fixed. It changes with how much you're consuming that thing. Another way of saying this is spending twice as much does not make you twice as happy. There's a certain amount of money you need to get the utility to make you happy, and spending more than that isn't going to improve your happiness level. So marginal utility has a negative second derivative, is what we're saying. The enjoyment as you spend, or the cost or quantity, it diminishes over time. Bill Gates is not infinitely happier than we are. He might be marginally a little bit happier, but not infinitely happier. So, it's something to keep in mind as you're going through life. All right, compound interest, opportunity cost, utility. Now let's kind of get into the weeds a little bit and talk about budgets. I should be mindful of our time. Okay, we're doing good actually. Okay, let's talk about budgets. Great quote from Warren Buffett. We don't have to be smarter than the rest. We have to be more disciplined than the rest. A very quick, off-the-cuff, if you've never gone through a budgeting exercise, this is the first thing you should do. Very simple. First, calculate your net worth. Add up all of your assets, subtract all your debts. So the balance of your savings account, balance of your checking account, balance of your retirement account, how much equity you have in your house, subtract the balance of your credit card, subtract how much you owe on your car loan, so on and so forth. This will give you your net worth. Hopefully, your net worth is positive. If you took out $500,000 in student loans, you might not have a positive net worth, but it's okay. You'll be able to recover, and this advice will help you. But that's your first kind of like litmus test of your financial, like how you're doing, is just look at your net worth, see where you're at. It's very easy to do. This does not need to be accurate. Precision has no benefit here. This is an off-the-cuff, round numbers are good enough type of exercise. Then itemize all of your fixed monthly expenses. It's important to understand where your money is going. There are tools to help with this. I'll come to those in a second. But you can pretty quickly, just go down the list. You've got your electric bill, you've got your gas bill, you've got your rent, you've got, whatever, just insurance bills. Like find out what your fixed expenses are. And these are the ones you're paying for, especially the essential things. Then write down your income. And then think about this equation. Your saving, or your ability to save, is equal to your income minus your fixed expenses minus your discretionary spending. The income and the fixed expenses are not numbers you can readily change. You can move and get cheaper rent, it's true, but I'm talking about things you can do like right now. So your income and fixed expenses are essentially static for the purposes of this exercise, which means that the two numbers that are variable in this equation are your saving and your discretionary spending. And it should be clear to you that making one go up makes the other go down, and vice versa. So play with this and think about, how much should I be saving? How much do I want to save? Set an actual saving goal numerically. And by the way, the only way to get to that is to lower your discretionary spending. You have to choose something to sacrifice if you want the savings to go up. Or you can go get a raise, but I'm talking about things you can do right now, today, without, relying on something like a raise or a bonus. Anyway, the art of making money. The art is not in making money, but in keeping it. It's a good proverb. Some really great financial goals you can set for yourself. There are a lot, and actually after I give this talk, I'd actually be very interested in what you guys think are great financial goals. I could have spent more time filling this out, but this is what I came up with the help of some other people. Thank you for your contributions. Save 50% of your take-home income. So your post-tax income, whatever that is, if it's $78,000, divide by 2, leave half of it in the bank and save that every single year. This is possible. Some people are raising their eyebrows at me. I can tell you from certainty that over the past 5 or 10 years, I have done this. It's not that hard. You just have to be disciplined. But the beautiful thing about that particular goal is that every 2 years, you are saving enough to pay for 1 year of future expenses. This is a really neat goal. Another great goal is to save 20% for a down payment to purchase a home. There are other wonderful, great goals. Find out what yours are. Let's talk a little bit about some of the tools. Quicken, Mint, Personal Capital, SigFig. There are a lot available today to help you with budgeting. These tools are incredibly powerful at aggregating useful information. It's basically like Fitbit for your finances, right? It tracks everything, it gives you real-time updates, tells you how you're doing towards your numeric goals or what have you. Things they will help you do, track your spending. They can kind of categorize it out too and tell you how much you're spending on electricity versus clothing versus whatever. They'll help you analyze your net worth, that calculation I just told you above. They can help you with that. They'll help you set numeric goals and keep whether or not you're on track for them. And they one of their most important usefulness, especially personal capital, is they can help you understand your asset allocation, diversification, and help you know how you need to rebalance your portfolio. I will come to portfolios and allocations and diversification tomorrow when I talk about the stock market. But these tools are useful for that as well. There are some things that they do not do, however, and those are the things that I'm emphasizing in this brown bag. They do not provide financial wisdom. They can tell you how you're spending, but they can't help you set goals that are reasonable or good for you. They can tell you, what your asset allocation looks like, but they can't necessarily tell you what it should be. Again, they're helpful to some extent, but keep them in their place. You need to develop the wisdom of what you need to do. You need to know what direction you should be walking, and then use these tools to help you achieve that. They're not going to change your habits. They'll just every month tell you how much you spend. Anyway, but they do have their place. They're helpful. Most of them are free, with some exposure of your personal information out there on the internet.
I would just argue
Yeah.
on that slide, though, that not argue, but say that you can't adjust what you're not tracking. So, like, having a view on using Mint or literally any other tool, like, can show you, oh my God, I'm spending $1,000 a month on going out to lunches or to dinners or whatever. And, like, you may not realize that that money slipping through your fingers at a $30 a day rate, because $30 here, $30 there, that's not a big deal. At the end of the month, oh my God, I could have been saving, whatever, using your.
I think you're making a good point. There is something to say that having the information is in fact useful. I would not disagree with that. But the caveat I would add to that is that you actually know how many times you ate out last week for dinner. You already know that. Okay? You don't need personal capital and Mint to tell you you ate out at restaurants 3 times last week. You can tell me that right now without looking it up. What you need to understand is the opportunity cost that has. And once you understand the opportunity cost of eating out, you'll be more in tune to making the decision. One thing to keep in mind about Quicken, Personal Capital, Mint, all of these things, the information they provide is after the fact. Okay? So if you really want to impact your bottom line, when you have that impetus to buy whatever, go out to eat or spend on this thing, the time and the place to make that decision is at that moment, before you have spent the money. Okay? If you wait for personal capital to say, wow, you spent a lot of money last month, well, now the money's gone. But understanding your habits, because your habits probably are ingrained, and you want to know what they are. My Cabela's habit really adds up, and if I had personal capital tell me how much my Cabela's habit actually was, I'd probably be terrified. And that exercise is worth the time. Joe is right.
It's the same as Fitbit or calorie counters, right? Like, they're
That's
not
why
going to
I put
make
that.
you thin, but
Right.
they will definitely, like, I have no idea how many calories I eat. But I'm sure that if I used Fitbit or a calorie counter, that, like, I'd be like, okay, well, that's where those go. And without that, like, it's really hard to know. I can tell you that, like,
They are
what's that, 1,000 calories in that burrito? I don't know.
They're absolutely like Fitbit, which is why I put that on the slide, right? Like, it'll tell you how many calories you're burning, but it's not going to help you get up early to go to the gym. That's something you have to do.
I would say if there's one thing that neither of you mentioned yet is how good they are when you behave. That, yeah, if you spend the money, you're going to look and say you spent a lot of money last month and that sucks. But if you don't spend the money, you're going to remember every time you went to the store and saw that pack of beef jerky that cost $6 and you really wanted, and you're going to remember that you didn't have it. And you're going to remember how bummed you were that you didn't eat that beef jerky those however many times. And you're going to have bad memories about that month. But if you then look on Mint or whatever and you see you saved $3,000 last month because you didn't have beef jerky, 500 times. Well, that's only like 15 packs a day or whatever. You're going to be like, well, okay, that's it's that reassurance that, it was a hard month, but you made it through it somehow. and it was worth it in the end.
I think that there's a lot of value to that, and like anything though, there are some kind of caveats. So one thing we're going to talk about tomorrow is the stock market. I have already made a very clear case that you should be investing your money. You should not leave your money in a checking account. This has the implication that every day you wake up, if you check the balance of your stock market to see, if beef jerky was satisfying, well, some days the market's going to be down and you won't get that satisfaction, from looking at your checking account. So it's important to know what you should be doing and to understand the financial implications of that, and it's extremely important to do it. Use the information, treat them like Fitbit. Figure out what works for you. I think it's important to understand your reward and your incentives and how you motivate yourself, because understanding how to motivate yourself will help you get closer. But everybody's got like a little, kind of a personal twist on that. You got to figure out what yours is. These are great contributions, though. I think it's there's a lot to it.
I like Excel.
Yeah, Excel. I use Google Finance as well. I have also written a number of Python scripts that do kind of some of my calculating that I like to play with. The one thing, actually, there's a bullet I had on the slide that I removed because I didn't want to be patronizing. But all of these tools are really fun for playing with numbers. It's fantastically entertaining. But the entertainment value is probably more important the value of the entertainment is not as good as the wisdom you should be focusing on. But they are fantastically entertaining. I like them. We can come back and talk about this, right? And I'd love to hear how different people use these different things, but in the interest of time, I already have too much content, so I'm going to kind of move on. Let's talk a little bit about insurance. What is it? Why do you need it? When do you need it? What should you insure against? What is the purpose of insurance? The purpose of insurance? Insurance is a form of risk mitigation. There is a risk. You don't want to be exposed to that risk, so you buy insurance to protect against the risk. This is really important, this next bullet point. Insurance is meant to protect you against very sudden, unplanned, and extremely expensive events. Okay, so if there is something that has the potential to actually bankrupt you, then you need to be thinking about whether or not you should insure against that. Not everything will bankrupt you. Not everything is unplanned, and not everything is sudden. You do not need insurance for things that are predictable and affordable. For example, dental cleaning. I cannot remember the last time all of the sudden I needed to get my teeth cleaned or I would be bankrupt. Okay, that is not what insurance is for. Now, I am not saying dental insurance is a complete waste of money and you shouldn't have it. I'm saying that is not the purpose of insurance in general. And it's important to understand the context of a thing for making decisions. Let's talk about risks you can insure against, protect yourself from with insurance. You can protect yourself from risks of harming yourself or harm to your family. Medical expenses are one of the best ones. Now I'm going to take kind of a detour here and tell you a story. I have a close personal friend that had a job, had medical insurance, going on about her life, totally normal, was kind of searching for a new job, found a new job, was kind of switching careers, and she kind of sorted out, so she was going to end her current job on a Friday, and she thought to herself, I haven't had a proper vacation in years, maybe I'll just take a week off. Instead of ending one job on a Friday, I'll take a week off and start the following Monday at the new job, right? Does this seem reasonable to anyone? Well, it turns out your insurance lapses when you're not employed. It expired, and in that 1 week time frame, her appendix burst. Instantaneous, unplanned, overnight, $30,000 to $50,000 expense. Boom. That is what insurance is for. Okay, I'll go back to it. Unplanned, sudden, and extremely expensive events. Okay, you need medical insurance. Medical risks are something you can insure against. Damage to your property. Your house burns down. Oh man, my house burnt down and I wasn't planning on it. Yeah, it's unplanned. That's the whole point. You get in a car crash. Man, I got in a car crash this morning. It's so expensive. It's like, I wasn't planning on getting in a car crash today. Right, that's the whole point. You weren't planning on it, which is why you need insurance. Car crash might not bankrupt you, but the liability from one could. Unexpected expenses. What if someone in your family dies and you had not set aside money to pay their funeral expenses? Oh, well, that is kind of like a weird unplanned thing. Like, that could happen to anyone. Could happen at any point in time, kind of expensive. Loss of income. What if you just lose your job? You weren't planning on losing your job, but could be pretty expensive if you lost your job. You can insure against that too. As you are talking about forms of income or insuring against loss of income, you are not necessarily insuring just yourself. You are insuring against the risks to your family. So however many dependents you have, however many people depend upon your income, that's what you're insuring. Not just yourself, but the impact to everyone if you lost your job or your house burns down or what have you. And then of course there's liability risks. Liability kind of depends on what you do or the types of hobbies you engage in. So you need to think about your profession and your activities and what you do, and think about your risk of liability. Let's talk a little bit about self-insurance. It is advisable. It is a better financial choice when it is possible, and I will underline it is not always possible, to self-insure. What does that mean? It means you put money in a bank account and you never touch it. You set it aside in the event that particular event happens, and you maybe invest it, but you never touch that money. It's just there in case this bad thing happens. But there are some things you can't self-insure against. So how do you know when you can self-insure versus when you need to purchase actual insurance? Here's a little bit of math. You need to compare the opportunity cost of paying insurance premiums over your lifetime. So we just did this, right? Opportunity cost is how much are you saving per month? That's the premium. Times the investment, 6% at the end of 30 years. Just calculate what the opportunity cost is. That's a number. And compare that with the expected value of the event you're insuring against. For example, expected value here, I'm talking about the mathematical equation expected value, which is probability times cost. For the types of events we're talking about, the probability is very, very low. It's a number between 0 and 1, much, much closer to 0. The cost, whatever that number is, could be very, very high. And when you multiply those two things, you'll find out what the expected value is, compare that to the opportunity cost. You can see whether or not it makes sense to self-insure. Things that are difficult to self-insure for are anything that's just extremely expensive. Because you can't say, oh, my appendix could burst or any internal organ could burst, so I'm going to set aside $50,000 for the insurance for each organ I have in a bank account. Like, okay, you'd need an enormous amount of capital to self-insure for medical expenses. I'm sure there are people who can do it, but yeah, anyway. So just think about the cost. If it's extremely, extremely expensive, if it could bankrupt you, you probably can't self-insure. Or, similarly, if it is relatively probable, the cost might be a little bit lower, might be reasonable, but if it's highly likely that it could happen, like a car accident, these happen all the time, maybe you can't self-insure for automotive liability. And I'm going to come back to that topic in a second, but examples when self-insurance does work better. I have a very cheap car. My car costs $7,000. Guess what the maximum cost of me replacing that car is? $7,000, okay? So is it worth me paying $1,000 a year insurance premiums for complete comprehensive coverage for my $7,000 vehicle? No, it's not. Because the opportunity cost of $1,000 invested at some reasonable investment layer way outperforms the expected value of my car getting totaled. I don't care, right? I self-insure for my automotive. However, you cannot self-insure for automotive liability, because if I get in a wreck with someone else, how much will it cost me to replace their car?
Depends.
Right? What kind of car are they driving? That I just get in a wreck with a Subaru or a Bentley? Like, oh, awesome. Did I injure anyone? So liability? Okay, not something you can self-insure against. So you got to think about, when does this make sense, when does this not make sense? Short-term disability is something probably you can self-insure against. We'll talk in a second about emergency funds, but if I just set aside enough money to pay my bills for a couple of months, I don't need short-term disability, because they solve the same problem. Except the difference is that the money I set aside to protect against this particular problem is also growing, whereas paying for short-term disability is an opportunity cost, right? So compare, think about this. Again, everybody's situation is a little bit different. There are times and places when short-term disability might actually make sense. One possible scenario is if you are pregnant. Short-term disability has maternity benefits. It can pay for your salary so you can take time off work right after you have a child. Maybe that's worth something. It turns out, if you calculate this, and I did recently, that it depends on how long you've held the short-term disability. If you keep it for a year and then you have a child, of course there's gotchas, because you have to keep it for at least a year, otherwise you don't get the maternity benefit. So they're kind of cheeky about that. But anyway, you can figure out what this is worth. Now let's talk about life insurance. Okay, what is life insurance? What's the point? Why do you need it? Why do you care? You might not. Life insurance is to protect your dependents from loss of your income due to your premature death. Think about that for a second. If you are single and you do not have dependents, do you need life insurance? No, not at all, because you're dead and gone. It doesn't matter if you get paid out the premium, you're not going to be collecting it. It's your dependents that collect the life insurance policy. Okay? So when you're thinking about life insurance, you need to think about your dependents. What are your dependents' needs? How much money would they need to replace your income? So the policy should cover all of your family needs in the absence of the providers. It's relative to your income level. If you make a lot of money and your dependents depend upon that money, like you've already got fixed expenses that consume all of it and you disappear one day, they'll need something to pay the bills while you're gone until they can sort it out. So this covers you, your spouse, your children. Also, life insurance isn't necessarily always required. As you get older and closer to retirement, you may not even need life insurance because your house is paid off, your kids have moved out of the house. What are you insuring against? Right? If your house is paid off, your kids have moved out, and it's just you, the life insurance policy is doing what? Yeah, maybe paying for some funeral costs or what have you, but remember, think about the situation your dependents are in when you're thinking about life insurance. This is a confusing topic, so I tried to consolidate it into one slide. You're welcome. Researching this by yourself is actually kind of a pain in the neck. There are different types of life insurance. They're all quite rather dramatically different from each other, and some of them are also very, very confusing. So here it is in 50,000 feet. Term life insurance is the most common. Term life insurance is much like automotive insurance. It's something at some point in time you decide to pay for, and it has a term, so you might buy term life insurance for 10 years or 20 years or 30 years or something. And while you're paying the premiums on the policy, you're insured. If you happen to die during that 30-year timeline, your dependents will get the payout. And at the end of the 30 years, the policy expires and your insurance goes away. You no longer have it. You stop paying, it disappears. It's the most common. It's also, by the way, probably the best choice. You don't really need it necessarily until you have kids. Right about the time you have kids, get a term life insurance policy. That's good for 30 years if you choose a 30-year option. By that time, your house is probably paid off. This is a reasonable choice. It's a good default. It's also the cheapest. But there are other types, there are other options. You should know what they are, you should know how they work. And the two other ones are whole and universal life. Whole life insurance is meant to be a policy that covers you as long as you are alive. You acquire whole life insurance, for the most part, with an exception I'll explain later, you pay the premiums on that until the day you die. And on your deathbed, no matter how old you are, no matter how long you live, you are going to get whatever you're insured for, 100 grand, million, 500,000, let's say 100 grand. So it's guaranteed to pay out that amount. This is how it works. You pay your premiums for a while. Those go into kind of like this weird savings account, bank account thing. And the policy gains what is called a cash value. So maybe you pay $100 a year. At the end of 10 years, the cash value is $1,000 plus some marginal interest that's not really that great. And if at that point in time you just decide, you know what, I want to keep the policy, I want to keep this coverage, but I'm kind of tired of paying the premiums, you can actually stop paying the premiums. And what it will do is deduct against the cash value. It'll start sucking the premiums. It will pay for itself, right? The difference on something like this is that the premiums on whole life insurance are a lot more expensive than the premiums on term life insurance. There's a lot of argument that says your money's better off in a better financial instrument. And we'll talk about what those are tomorrow. But it is an option. It has a bigger role in like family planning and estate planning, and as it does is just like pure insurance. But it exists. It's a thing. The younger you are when you acquire a whole life policy, the cheaper the premiums are. ... You can buy this for your children, and they'll have really, really, really cheap premiums their whole life that you'll have to pay for like the first 20 years, and then they can take over. Okay. That's whole life. It has a cash value. Okay, that's one thing that's kind of different about it. You can take loans against that cash value and never pay back the loan. It's a funny perk. It's kind of weird because you could have just kept the cash and then you wouldn't have needed to take the loan in the first place. So it's kind of a financial instrument that gives you some weird options. But it has its place. It can be useful, especially if you think about it really young and you know you can get a good deal on the premiums. These can be worthwhile. But if you're not sure, term is the way to go. Universal is a type. It's a more complicated permanent policy like whole. It's similar to whole life, has the same basic cash value, same basic you can take a loan out against it, same basic it covers you your whole life. But it has very, very flexible options. You can scale up how much premiums you want to pay. You can pay more at your discretion. You can pay less at your discretion. And as you do that, your benefits go up and down. You can kind of like, everything's a variable. It's like whole life insurance, but instead of all the numbers being fixed when you purchase the policy, all the numbers are variables and you can adjust them as you go, as your situation changes. These things are complicated. It's not clear if there's any benefit to this. There's a lot of debate. It's very confusing. If you really want a life policy, whole's probably better, but this gives you an idea of the basic differences. You can do your own research. Okay, now let's talk about the emergency fund. This is an important topic, and it begins kind of actually how do you invest, how should you invest, how should you set up your money. Okay, the emergency fund is a form of self-insurance, like short-term, right? Like loss of job for short-term. So emergency fund is a form of self-insurance against losses incurred from unexpected expenses. Those expenses include, for example, let's say, this happened to me a couple weeks ago, all of a sudden my cat had a problem, I had to take it to the vet. I wasn't planning on that, all right? So, but I have an emergency fund that could pay for the vet bill, all right? So the expense itself, it's an emergency fund for unexpected expenses, including the expense itself, the vet bill. But if I did not have an emergency fund and I needed to pay for that vet bill, maybe by selling stock, having an emergency fund actually insures me against having to sell stock at a bad time. Once you put your money in the market, you want to be able to leave it there for a long time without taking it out at bad times. So if the market's down and my cat gets in trouble, I'm really going to be kicking myself if I have to sell stock for a vet bill. And the other thing is if you don't have cash set aside to pay for these things, then you might be putting those types of expenses on a credit card. Credit card has high interest rates, so the emergency fund is a form of self-insurance against the expenses incurred from the interest rate on credit cards, right? So all of these things. It needs to be highly liquid. We're talking about cash or a cash equivalent. You need to get at it when you need it at very little notice. You should have an emergency fund that's big enough to pay for your living expenses for 3 to 6 months. All the finance wizards of the day will agree 6 months is a good number. That's how much cash you should have set aside to pay all your bills for 6 months. It needs to be highly liquid. It needs to be in very low risk. Your emergency fund, you don't invest that in the stock market. For the reason I just explained, when the market's down, if you need your emergency fund, you have a problem. So highly liquid, low risk. We're talking checking or money market fund. As a side note, emergency funds are not for planned expenses. Your money you're saving to buy a new car and your emergency fund are not the same thing. Do not confuse them. Your emergency fund is for emergencies. Your savings account that you're trying to get a new car with is something totally different. It's a great thing to save for. It's not your emergency fund. They're different. For example, what happens if you lose your job while the stock market is down? This is a really common one, right? Like the economy tanks, we go into a recession, lots of people get laid off, all of their investments are down at the same exact time, and now they have a problem. So they might, this unexpected event might cause them to have to, sell their retirement funds at a bad time. Like, you don't want to be in this situation. So how should you set up your emergency fund? I really like multi-tiered emergency funds. You see, the thing is you don't actually need all 6 months of that money all at once. So you can stage it. You can take the first 3 months and put it in your checking account, or better, a high yield savings or money market account, but something that's extraordinarily liquid and has extremely low volatility. At the same time, based off of those observations, you're also going to get very low return on it. But you can take the next 3 months, the second 3 months, and you can put it in something like a short-term bond fund. I'm being specific here on a really good one that you can do. Short-term bond funds, I'll talk about bond funds tomorrow when short and long-term and all of that. However, bond funds are very, very safe. They're as safe as cash because guess what? A dollar bill is a piece of paper that the government says, yeah, this is worth $1. Well, a bond is also a piece of paper that the government says, yeah, this is worth whatever. So bonds have the same safety as cash. They're not quite as liquid. They do have a certain amount of volatility, something we'll talk about tomorrow, but the volatility is extremely low and they grow pretty well, 2 to 4% per year. It's worth putting some of your emergencies fund in something that performs a little bit. You'd be making a couple $100 a year, and that's worth something. Roth IRAs, actually, you cannot, when you put money into a Roth IRA, you can pull out the principal, the money you originally deposited. You cannot pull out anything that it grew into, so any earnings, but they can play a role as part of your emergency fund in a pinch. It's better to keep these things separate, but it is an option to you. And another thing you might consider is putting your emergency fund in different financial institutions, depending on how paranoid you are. But again, we're talking about emergencies, which include things like economies crashing. All right, now let's talk about retirement planning, part you actually care about. All right, questions about retirement planning. When are you going to retire? How long will you live? What will your living expenses cost when you retire? Will you rent or own your home? How much money will you need per month in retirement or per year in retirement? Like how much money do you actually need to live off of? Are you going to qualify for Social Security? And if so, how much will you get from it? How much should you be saving now to meet those goals? It's a handful of questions. There are a lot more questions, but we don't have time for everything, so let's do these. Everybody's like, oh my gosh, you've already been talking for forever. Okay, let's make a few assumptions about retirement. I have to make assumptions because everybody in this room is a different age, so you need to think about your personal situation. Plan on working till about the age 65. the reasonable assumption. 65, 67, this is when people typically try to retire. Based on the typical average life expectancy in the United States of individuals, blah, 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 yeah, you're probably going to live till about age 90. Some people live longer than that, some people don't, but it's kind of like the global average life expectancy. It's not bad for off-the-cuff math. Assume that inflation will be 3% a year. I will explain what inflation is and why you need to care about it. Assume that your investments will return about 6% a year. Again, I'm being a little conservative here. Depending on which financial advisor you believe, the historical stock market average return on your investment is maybe 7%. I've seen numbers higher than that, 7.5%, sometimes 8%. But point being, just about everybody agrees it's at least 6%. So it's a good number to work with. And then there's another number here is once you hit that retirement age, you're probably going to be withdrawing from the amount you have saved at about 4% a year. We'll talk about that. Off the cuff. Multiply by 25 method. You can Google that term. It'll come up with a lot of explanations. Let's suppose you are planning on living, or you're going to be retired for a period of 25 years. And that is, by the way, if you retire at 65 and live till age 90, 25 years. Determine your income requirements per year. So let's say I'm going to retire. I'm going to be retired for 25 years. I'll need $80,000 every year to live off of. $80,000 times 25. It's not rocket science. Question?
Should be using pre-tax or post-tax income right there.
Post. Because this is money you're spending.
Gotcha.
Good question. Now, there are a lot of calculators on the internet. They all kind of make assumptions. A lot of people like to make the assumption that if you make whatever you make today, when you reach retirement ages, or when you reach the age of retirement, yeah, your expenses simplify a little bit. You're probably not driving as much. You don't need to commute to work. You don't need to pay for some of that stuff. So a lot of people think, you need about 80% of your current income level when you're retired, kind of to maintain the current lifestyle. So that's something, if you make $100,000 a year and you need 80% of that, based on your lifestyle, you probably need about $80,000 a year. And that does, some of the assumptions is including things like pre versus post-tax income. But again, this is a huge assumption. Everybody's situation is very different. Anyway, but that's what that works out to. So if you take the $80,000 number and you multiply it by 25, you need $2 million saved to retire at age 65. Anybody think that is unreasonably high? It seems like a big number. It's a hard number to save for. It's probably pretty close, though. If you think you can live off of $50,000 a year, if your lifestyle, you have already adjusted your lifestyle and you know what your expenses are and you know you don't spend $80,000, maybe you can skim by on $50,000 a year. In that case, you only need $1.2 million. So there's a huge range of numbers, and unfortunately I can't be like, you actually need this much, because everybody's situation is a little bit different. Let's talk about safe withdrawal. So you saved all this money, you invested all this money, and at the end of the day you saved $2 million or something, right? How much money can you withdraw in the first year and not run out over a 30-year timeline? So some people have done some math, and there's a lot of research studies that have analyze this. Basically, they say 4% is safe. So if the first year of your retirement, you take whatever nest egg you've built up and you withdraw 4%, let's just call that amount X. Okay, 4% of your total savings is amount X. You can withdraw that. Now, it's invested. It's still invested, so it's going to grow a little bit. So whatever the 96% that's left over is going to grow a little bit. And every year you pull out of it, it's going to grow a little bit less, but it's still going to grow. But this idea of figuring out what X is and just withdraw that much every year, the research says it'll last 30 years. Gives you an idea of how these things are. Now you can work backwards from that. So if it'll last 30 years, whatever your nest egg is, and you can withdraw 4% the first year and it'll last 30 years. All you need to do is say, well, how much do I need per year? How much am I going to withdraw? What is X? X equals $80,000. Divide by 0.04. And assumes that you would need $2 million to retire. It's convenient that the math is identical to the previous slide. This is actually a different equation. It's a different theory. But the math works out in agreement, mostly because I'm using the same numbers, the 80,000. But there are ways to think about how much retirement you actually need. There are a lot of good retirement calculators online. Vanguard, the one on the left, NerdWallet top right, and something called FireCalc on the bottom right. I'll let you read about what that does. It's a little bit different. It has to do with risk planning. But they're pretty good. They'll let you punch in a bunch of numbers, make your own assumptions. I saved this much. I've already saved this much. This is how much I'm going to need. I expect the stock market's going to return 6%. And it'll tell you how much you will have in retirement versus how much you need in retirement. It'll kind of give you a litmus test of how close you are. Just as a litmus test, with the $100,000 number, assuming you are age 35, assuming you save $1,000 a month or $12,000 a year is your rate of savings, and assuming you already have set aside $50,000, it's already in the bank, already in your retirement 401k, and assuming you need 80% of your income, you are about 45%. You're making decisions that are about 45% of what you need to be making. So you need to tweak those numbers. You need to either save more per month, assume that you're going to need less in retirement, make more, be younger. You always choose to be younger. It's like the best, absolutely the best choice. Anyway, these calculators let you play with the numbers and get a feel for where you are. They're kind of fun.
And this is per person, so a couple needs 4 million.
Kind of. So that's actually a really good point. Does a couple need double this? Not necessarily. You're sharing the roof over your head.
Probably.
You need more for 2 people, certainly. How much more? I wish I could tell you. Well, actually, that's a really nice segue to my next slide. So one thing about these calculators, you guys, you have any idea how many assumptions are on this page? Like just about everything is an assumption except your current age and your income. You know, and it's like 80%. Well, what if it's 70%? What if it's 6%? How do I actually know? I like to. What's that? Oh,
To myself.
yeah. Assumptions are awesome, right? So it's like this is like a litmus test. If you really want to know how much you need to retire, what you need to do is go back to that budgeting exercise. How much are you spending right now today? So get out a calculator, fire up Sig, Fig, and Quicken and Excel. And figure out what your fixed monthly expenses are. It's a good part of your budgeting anyway. Figure out what they are. Itemize your itemize your expenses. Make a decision. Are you going to own your home or rent a home? If you have a mortgage, you're already on track for that. But this is important. A lot of people overlook this. If your plan is not to own your home, your retirement planning needs to calculate 25 years times 12 times your rent, in addition to the $2 million it thinks you need. Okay? You need to know if your house is part of your retirement plan or if you're going to be paying rent. Rent doesn't pay itself. You need to save money for that too. Yes?
You say in addition to the 2 million, but didn't that 2 million number come from the fact that you're assuming you'll need 80% of your income? But the 80% of your current income is already paying towards this.
It might. The 2 million might include it. The 2 million is also an extraordinarily fictitious number. So, the point is like, there are assumptions and there are like actually itemize your expenses. The link, the blue text. Oh, by the way, the blue text is always a link in these slide decks, and you can look at this later. That is a link to Vanguard's retirement expense tracking, where it figures out like. You need healthcare, you need dental care, you need money for laundry, you need it's like this long list of expenses you should be thinking about in retirement to help you with this process if you're going to take the time to itemize your expenses. But as you're saying, you don't want to make an assumption about that. You just want to know if you're including in that 80%, $80,000 a year is enough to pay for your rent, then that's it. You have accounted for that. Just don't forget to account for that, right? But yeah, the calculators are probably accounting for rent, probably. What they're not doing, maybe, and again, think about the assumptions. Are they accounting for the fact that rent is going to be higher 30 years from now? You should call your local retirement calculator developer or look at the code and see if they actually account for that. Or itemize everything, add it up, see what it's going to cost you, and then account for inflation, 3% per year. Talk about inflation in a second. Then multiply by 25 is the number of years you expect to be in retirement, and that's about how much money you're going to need to retire.
A couple of
yep.
things on this slide. You mentioned it, but just to reiterate, that's 3% compounding. Remember the compounding slide earlier? That's a huge, huge number. Like,
Yeah.
what you're going to need by the time you're 65 and by the time you die, 3% compounding is a lot of money. Not $2 million
Yeah.
a lot of money, a lot more than $2 million a lot of money.
Yeah, so in case the microphone didn't catch that, this is an important thing, and I'll even say it again. Inflation compounds. I have a slide on this. It's probably the next slide. But that 3% is compounding 3%. Hugely important to take that into consideration.
Don't you need to account for inflation for up to the point you retire as well? So the expenses that you're calculating are based on what you're paying now, but you'll also have to account for inflation up to that time you hit 65.
That's what I'm trying to say.
Yeah.
So what I'm saying is
But then it
calculate
says 25 years in retirement.
maybe these should be two separate bullets. So to clarify, you need to calculate your current living expenses. That is a number. Now compound by 3% based on whatever age you are now and whatever age you're going to retire. And that's your expenses at the retirement age of 65 will be whatever after you compound for inflation. That's a number. Now multiply that number times the 25 years you'll be in retirement. These are off the cuff, planning things, but it gives you an idea of how most financial experts recommend that you should look at this problem. You cannot know the future in its entirety. These are good guesses, but it'll get you close.
Multiply that by 25, but then you also have to consider that obviously
Inflation will
inflation
continue.
will continue.
Yeah, exactly.
After that. So at the end of your life, you're still going to need more,
Yeah, exactly.
more money. One thing that we've talked about many times is there are huge risks in underestimating how much you're going to need. There are not a lot of risks in overestimating what you're going to need. So if you're like, I don't really want to be homeless when I'm 85, which personally, I don't want to be homeless when I'm 85, it's in more of my best interest to not make any assumptions of like, well, I could probably squeeze by on 50 grand versus 60 grand or whatever. You know what? If you're concerned about it, assume you're not going to have your car paid off, you're not going to have your house paid off, that inflation is going to be 4% or whatever you're going to do. Just like you want, frankly, as much money at the end of your life as possible, because on the other end of the spectrum, you literally can't pay your bills. I have a neighbor who is retired and has a really hard time paying his mortgage every month because he kind of miscalculated. And that's a bad situation because he could lose his home, and that sucks. So don't let that happen to you.
Where do you
Good thoughts.
juggle this is my problem, like enjoying your life now when you're young and going on trips and that versus saving for a possibility that might never come?
That's the opportunity cost question.
Okay.
So, opportunity cost is a calculation you may make to say. Again, in case the microphone didn't catch the question, how do you know whether or not you're safe spending that money on a vacation this year versus you really, really should be saving for retirement? How do you decide whether to draw that line? What you do is you look at your net worth or what have you, and then you say, okay, the vacation's going to cost me $2,000. A week in Thailand or something. $2,000 compounded at 6% for 30 years is the opportunity cost of that vacation. And then you look at, is it worth it to you? Is it really worth it? Are you on track for retirement enough for that to be a good use of money? Or are you so far behind, and then you got to play this game, because utility is this interesting thing where you want to maximize utility over your lifetime. You don't want to sacrifice all your current happiness for future happiness. And you don't want to sacrifice all your future happiness for current happiness. You need to strike a balance. Striking a balance is always the most noble of goals and the most difficult to achieve. Right?
I just read the story, The Ant and the Grasshopper, to my kids.
Nice.
Like, literally like
The ant's got all the food and the grasshopper.
Right, exactly. So I think this maybe gets into like some personal details now. So to say anything more specific than that, you would really need to look at your own personal accounts. Okay, to carry on, because what am I at, like an hour and 12 hours, and I've got 3 more hours to go. Again, I'm sorry for how long this is taking. It's a lot of content. Tomorrow's will be longer. Okay, so how much money do you need to save now to have $1 million at the age of 65 or something at retirement? I forget what they assumed in this slide. This is a link. You can click on the image and it will take you to the study. How much money do you need to save now to have $1 million at age 60 or 65? Or probably 65. If you're 20 years old, you need to be saving $360 a month. At 25, and again, this assumes 6% return on your investment. At age 25, you need to save $500 a month. At 30, $700 a month. 35, $1,000 a month. 40, $1,400 a month. 45, $2,000 a month. 50, $3,500 a month. 55, $6,000 a month. And if you're 60 and you only have 5 years to save, and you can only get 6% out of it, you need to save $14,000 a month.
you're not retiring.
You are not retiring. Rules of thumb, good to think about. Let's talk about inflation a little bit before everybody falls asleep. Oh wait, this is the slide that will put you to sleep. All right. Every time I've had a talk about inflation with a financial expert or someone who knows what they're talking about, I can guarantee you the experts do not agree about this topic. So please do not ensue the flame war towards me, because this is debatable. I tell you what you need to know, what is kind of not debatable, and you can go debate the rest with other people another time. The most important thing you need to know about inflation is that it is in fact real, and you need to plan for it. Inflation has the effect, and maybe some experts disagree, but this is a pretty good rule of thumb. Inflation has the effect that prices double every 20 years. So today your phone costs $1,000. 20 years from now your phone will cost $2,000. Now you can already see why this is debated, because but technology gets cheaper, blah 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 blah. All right, I don't want to talk about it. Prices double about 20 years. This is the number you need to use for planning. This applies to rent. This applies to groceries. This applies to the things that matter. The point is, the purchasing power of the dollar does decrease over time. $1 today will buy you twice as much as the same dollar 20 years from now. Why does that matter? It matters because you cannot invest in cash. If you put your money in cash and you hold on to it for 20 years, guess what? Now it's half as useful. Right? Every 20 years, the cash in the bank loses half of its purchasing power. Okay, cash is not an investment, and if I didn't nail this hard enough with the opportunity cost slide, I'm going to say it again with the inflation slide. You need to invest. But, the good news is your purchasing power, this is relative to your income. As the prices of goods increase, so should your income if you're working. Of course, this has not always been true. There are a lot of scenarios in the last couple of years where some of them where maybe prices increased a little bit, but salaries sure as heck did not in general. So again, this changes over time. In 1913, so about an even 100 years ago, The Ford Model T costs $575. Gasoline costs 28 cents, and the average income of the United States worker was $800 a year. Again, this is like super generic, off-the-cuff rules of thumb. They're not going to be precise. Something that cost $500 100 years ago is probably about $20,000, $25,000, you know. Cars, it depends on whether we're talking about Bentleys or Ferraris, you know.
You could get Ford for.
I like old broken Volkswagens, for example. They're a lot cheaper. Point is, inflation is real. That 3% I'm talking about, 3% per year, that actually does happen. You do need to pay attention. Now, I said cash is not an investment. It's not. But that doesn't mean you don't need cash. For example, it played an important part of your emergency fund. Part of your emergency fund basically did need to be in cash, and that is a good choice. Cash provides liquidity. It provides diversification, and those are really important things. You just can't put all of your money in cash. Most of it needs to be in a better investment. Social Security. All right. If inflation was boring, Social Security is even more boring. Will you qualify for Social Security? Do you know? Have you ever thought about this? What does that even mean? As you work and pay taxes, part of those taxes go to Social Security tax, you earn credits. Every $1,300 you earn in a year, you earn 1 credit. They only allow you to accrue 4 credits per year. You're like, what? I didn't even know there were credits. Well, I'm telling you now, there are credits. You can earn at most 4 credits per year as you pay your taxes and you work. You must have a minimum of 40 credits to qualify for Social Security. Less than 40 credits, you get nothing. 0, zip, zilch, nada, you don't qualify. If you have over 40 credits, and you can only accrue 4 per year, at most, then you do qualify for Social Security. What is the point? The point is you must work at least 10 years, 10 full years to qualify for Social Security. Now, how much will you get? Well, there's a calculator for this. It's linked. One of those is a link to the calculator. It's kind of it's not super complicated equation, but more than I could really explain on this slide. The bottom line is your benefits are relative. Part of the thing that goes into the equation on how they calculate this is your average income over 35 years. So, if you work 35 years and you make a good salary all 35 of those years, that plays into the calculation. But if you're super smart and you earn a lot of money all at once and then you retire early and then you get a bunch of zeros for your average income, well, that pulls down the average a whole lot. You thought you were being smart about retiring early and then it pulled this down. Yes.
Small question about this. Say
Yes.
you work for 50 years before you retire. Is it going to choose your top 35 years? Or your most recent 35 years?
That's why that's a link. Go read about the equation. Yes.
Is there a cap?
Is there a cap? It's based on your average income. The cap, I think, is $250,000 a year per person or something. Like it doesn't consider anything above that. The equation, remember, it's quasi-complicated how they calculate this. They're trying to be fair. They're trying to take into account a lot of things. The thing you absolutely must know and never forget is you need to work for 10 years to qualify. Anything less than that doesn't qualify. That's the most important thing. The rest is minutia. You should go read about it. There's a link there. You can go read about it. Few things, other things that are worth knowing. Even if your spouse does not work, if you do and you qualify, they also qualify. That's called the spousal benefit. I didn't know this until recently. But your spouse that did not work qualifies for Social Security. That means, by the way, if you're married and you have a spouse and they define how long you have to be married and all the, again, minutia, that you will get your benefit and they will get some benefit, but you will get 100+% benefit as a family, right? So it's not a subset of yours, it's actually in addition to. So that's kind of cool. You can, at the ripe young age of 67, sign up for Social Security to start claiming your benefit. If you choose to wait a year or two past 67 to claim it, you will get paid more per year when you do. There's some incentives for delaying your claim on your Social Security paycheck. However, that's like not past age 70. You need to claim this at some point in time. That doesn't extend forever. Another gotcha. You need to sign up for Medicare 3 months before your 65th birthday. Seems a little bit arbitrary, but if you do not remember to do that, your premiums, your Medicare premiums, will cost you more than the person you're standing next to, just because you forgot to sign up. You get less, your healthcare becomes more expensive. It's fascinating. Love the government. More questions about Social Security? Yep.
Will it exist when we're old enough to do it?
I can say,
For me, yes. For you, no.
I can say with almost certainty it won't exist when you're older. I'm sorry. No, but it is a reasonable question. Will this exist? You shouldn't plan on it. And actually, if you do, one of these links is to a calculator that you can calculate your expected benefit. If you do take the time to go through that, you will notice over your entire retirement, over the 25-year period that you're retired, if you're making more than $100,000 now, you can count on, absolutely guaranteed, Social Security for a 25-year timeline will make maybe $200,000-$300,000. It's a pittance. Okay, so like even if you do qualify, you're not getting a lot out of this, right? This is to keep people from bouncing off the bottom. If you just ignore that it exists in your financial planning, you're probably better off for it. I just wanted people to know, don't quit on year 9. Like, hang in there, one more year. All right, should you rent or buy your house? That's a good question. So why would you want to buy a house? Buying a house is a great hedge against inflation. We talked about inflation. If you purchase a house with a fixed interest 30-year loan, your housing costs are now fixed in today's dollars. As the rest of expenses and rent gets more and more expensive, guess what? Your house doesn't get more expensive. So buying a house is a good hedge against inflation. It fixes your housing costs at today's prices. So you don't have to worry about them going up. You do have to worry about taxes on your house going up, though. That's important. Also, reasons to buy a house: the mortgage, the interest, and property tax deductions in our tax code in the United States really help reduce your taxable income. They make a big difference to you now. They keep money in your pocket. Why is our tax code skewed to make life better for people who own houses and to make life less better for people who don't own houses? Ask the 1%. It turns out actually the benefit is pretty, the interest deduction is big. You do end up, our system is skewed to favor people who buy houses. It is, I'm sorry, that's the way it goes. But keep in mind that a house is both an asset and a liability. That as your house grows in value, it's an asset, it's an investment, you can sell it and get your money back. But if the roof starts leaking, now all of a sudden it's going to cost you money. It's also a liability. You need to plan for that. So it increases your financial obligations. You also get tax benefits when you sell your primary residence. You had been living in it actively, like within the last 5 years. Like there's some gotchas and some caveats, but generally speaking, you pay less taxes on selling a home than you do on other things. ... But keep in mind, as your house gains value, so does your neighbor's house gain value. So if you think you're going to sell it for the sweet profit and take the capital gains and go buy a better house, that's not the way that works. You move sideways. You can buy the same exact style of house because yours, maybe you bought it at $300,000 and now it's worth $500,000, and you sell it and you're like, sweet, I got this awesome profit. And you go to buy another house, guess what? The same exact house down the street is going to cost $500,000. So the only way to really make that, useful to you is to downsize. Like buy a smaller house. They move to a cheaper location, and then you can capitalize on selling your home. Property taxes will increase. If you don't buy your house, you need to plan on for rent. We talked about that already. Yes.
You talked a little about like mortgage interest and stuff like that, tax deductions, how the system is kind of skewed to favor people who buy.
Mm-hmm.
Is it skewed so much that it's not advantageous to just kind of save up money and then buy a house all like outright instead of mortgaging it all? Or is it still better to buy a house outright and not worry about mortgage interest at all?
That is an excellent question. It's also a hard question to answer because when you purchase, because remember, you're paying interest on your house. This kind of goes back to that delayed gratification slide I had, right? Where if you just hold on your money a little bit, If you hold on to your money a little bit longer and let it grow, you are gaining capital year over year. It's growing. So maybe you can just save and buy a house outright, or at least wait to buy, and you'll end up in a better situation. That's what the delayed gratification slide. What I did not explain at that point in time is that there's an important thing here. The car loan I had on that slide. Oh shoot! I should just go up. I'm gonna come back. Sorry guys. Nope. Yes. Okay. So, delayed gratification. Should you wait, save your money, buy a house with cash? That's the blue line. Should you buy it now with cash? That's the green line, maybe. The red line is financing a house.
One
Okay.
thing this doesn't include, though, is if you don't buy a house, you're still paying rent somewhere.
Correct.
In the
So
portfolio.
if you don't buy a house, you're still paying rent somewhere. So this does not account for that. It's very true. But the other thing to consider here is I made a very funny assumption when I made this slide, and I calculated these numbers a couple different ways and chose this one as the most interesting. That red line is a loan at 6% for 5 years. You change the loan parameters if, for example, your investments are growing at 6%, but your loan is only a 3% APR. That's cheap money. You might not be able to do better than that. That's interesting. But if that loan, my dad, when he refinanced his house back in the 70s or 80s, he was telling me that the interest rates during that time were 17% for home loans. 30-year fixed home loans refinanced. 17% APR. You start talking about numbers like that, and you don't want to borrow money at any cost. I mean, that is any cost. That's ridiculous. So you need to ask yourself, what is the APR on the loan, and what are my investments performing at? Basically, what I'm saying here is 3% loan, 6% investments, doing good. It's a nice loan. 8% loan, 6% investments, pay off your house sooner, right? Don't, you're better off paying down your home versus putting it in the stock market. But notice, the 6% and a 6% growth are not isomorphic here. So that green line is a 6%. It grows at 6%. You spend the $10,000 all at once. The red line is a 6%. You see, you got to remember, if you leave part of your money in the market, it grows a little bit. It's complicated, but hopefully that gives you the numbers to tweak.
Makes sense,
Yeah.
right.
All right, back to insurance assumptions. We covered a lot of ground. Part 2, where are we? Oh yeah, rent or buy. Oh, we're almost done. Okay. Okay. Buying a house is a great hedge against inflation. It's both an asset and a liability. All right, we're good. Buying a house, by the way, we could spend an entire hour talking about whether or not a house is a good investment. And I plan to. That'll be Brown Bag 3 maybe. Yeah, part 3, the intricacies of buying a home and things. Okay, a few other thoughts. We kind of talked about this a little bit already, but I didn't know where else to put this, and they're kind of important. But you got to remember balance, right? You can't sacrifice all of your current happiness for later happiness, but you certainly don't want to sacrifice all your later happiness for current happiness. So balance is important. Maximize your quality of life over your entire life. Okay? And then the other thing, and Jason was telling me this, and I thought it was an interesting statement, but you spend all this time saving money, living frugally, putting together this great nest egg. You take this great nest egg, you put it in a bank account, you've been avoiding Netflix, you haven't had a Prime account in 1,000 years, you haven't gone on a vacation in 30 years, all of a sudden you retire. You've trained yourself to save money and not spend money. So you're worried that you're gonna run out of money before you retire, so you don't spend any money the first year, and then you don't spend any money the second year, and you continue to live frugally through retirement. Guess what? That's also a mistake. Why? Because you saved all this money for retirement, you actually do want to enjoy it while you're young enough to do so. If you live so frugally that you have all this money when you hit 90 and you're like, yay, I've still got $1 million left, I'm good. Yeah, but now you can't enjoy it, right? So making the opposite mistake and spending too little too early in retirement, can also be a problem. So balance. As always, it's everything. Where do you start? Of course, it depends on where you're at right now. But the first thing you should do, if you're trying to retire, is increase your rate of saving. The opportunity cost of not doing this is huge. The second thing you should do is build your emergency fund. 3 to 6 months. Start with 3, then get up to 6, and then that's good enough. You should be contributing enough to your 401k to maximize any employer matching. And then you should pay off any high interest debt. Paying off high interest debt goes back to that delayed gratification slide again, where it depends on what the interest rate of the debt is. If the debt is compounding at 6% and your investments are growing at 6%, it's kind of a wash sale, right? But if your credit card 15% is compounding against you at 15% and you can only get 6% in the stock market, you should be paying off your debt before you start investing, right? So that's what I mean by high interest. Then you want to start saving for retirement, because this is going to take a fantastically long time to get there. Once you have started putting away a certain amount per month for retirement, you can start saving for other goals like buying a house. Then after that, it's up to you. That is the end of day 1. Tomorrow we will talk about all things stock market, bonds, funds, taxes, incentive stock options, taxations, capital gains, progressive tax rates, all the stuff.
So 3 hours tomorrow.
What's that?
So 3 hours tomorrow.
3 hours tomorrow as well. With that, thank you for listening. We'll pick up again tomorrow. I'm sorry this is so long. I'm trying to condense a lot of information. Yeah, I'm going to stop the video, and then we can have a nice brown bag, or a nice